Welcome to Market View with Ike Iosa and Friends. The show that not only reveals and analyzes the inside story on today's market news, but also uncovers the areas where investors can make money right now.
Morning. Mike Iosa, your host for my music guest. Our very famous Mark Arbeter. Hi Mark, how are you?
Great, Ike, how are you?
I'm doing well and curious to hear your thoughts. We're at the end of the quarter. Many markets are making new all-time highs. What are your thoughts going forward?
Yes, the S&P 500 has broken out. If we go to the first chart,
Okay.
broken out of a V bottom with a handle, another V bottom, the technician's nightmare. You could also call this a continuous inverse head and shoulders, which is obviously a continuation, not a bottoming pattern during a major correction, but it's a continuation pattern of an uptrend based on the size of this pattern of the V bottom and the inverse head and shoulders. We could come up with measured move targets between 6,000 and let's say 6,500. In the very near term, the market feels, although it's been grinding higher, which is exactly what you want it to do, not too hot, not too steep, it does feel like the market's a little tired here. Some trepidation, I'm sure, going into the month of October, which has been shown to be a tough month during the presidential year election cycle. So there's, some anxiety, I guess, as we get closer to the election. My opinion is it doesn't matter almost who's president. The market will do what the market does.
I agree.
The market can do well under Democrats and Republicans. Just let them, leave the market alone, and it'll do just fine. I could say that same thing about the Federal Reserve, but that's for another day. So if we go to the second chart, we have a weekly of the S&P 500 and weekly Bollinger Bands. I found the best combination of moves, consistent moves, happen when the S&P just grinds higher. As I said, doesn't get too steep, and basically the S&P will stay in between, its middle band, which is a 20-week moving average, and the upper Bollinger Band or volatility band. And we saw that back in the latter part of 2020 after the pandemic, in through most of 2021. We stayed, right in between those two bands, and then started again here, late in 2023. We got into that, got above the that middle band and have stayed basically in between, basically on closes of the week, stayed in between that middle and upper band. So in my eyes, this is the perfect scenario for the market. Not too hot, not too cold, just trending nicely higher. If we go to the third chart, we have a weekly chart of the S&P 500 on the top panel. Second panel is the S&P 500 weekly advanced decline line. Third panel is the advanced decline line of the S&P 100 or OEX. And then on the bottom panel, we have the price action of the S&P 100 OEX itself. Both the 80 lines of the 100 and 500 are at all-time highs. For the 500, I believe the 80 line broke out before price did. OEX probably did about the same time, but that's bullish action from breadth. When breadth is leading price or coincident with price, generally that's a positive scenario for stocks going forward. The number of stocks in these indices above their 200-day, I believe it's 88 for the OEX, and I guess in the 70s, mid-70s for the S&P 500. So, the majority of stocks, especially in the S&P 100, where it really matters, where the weight of the market cap weight comes into play, is very, very strong, and that's generally a good sign. Moving to the chart number 4, this is where I see some potential inflection points. While these trends that I'm going to talk about continue, I think the dollar and gold in this particular chart might be nearing a turn. So the top panel shows fairly consistent decline in the US dollar, USD, and we have held so far this support around 100. To break higher, I think we bust this trend line. It would create a minor false breakdown. The reason I'm looking for a potential bottom in the dollar is twofold. The COT data has turned bullish for the dollar, and the last 3 or 4 times this has happened, where the commercial hedger smart money has gotten increasingly bullish and the large speculators have gotten a little more bearish. The last 3-4 times this has happened, it's almost been coincident with a dollar bottom. It's been very close. Many times with the COT data, the commercial hedgers will be early, weeks, sometimes months, which can be very frustrating, but usually they're right. So I think if we do get this turn in the dollar, plus sentiment, the second thing is the sentiment toward the dollar is pretty lousy. In itself doesn't say the market's bottoming, but I think it's another piece of the puzzle here. So if we move to the third panel, we have GLD, which is hitting all-time highs every day, helped by not only the weakness in the US dollar, basically a trend of lower yields for the most part. So it's got, a lot of tailwinds behind it. But we have gotten pretty steep here over the last week or so with this move, which typically suggests we're getting towards the end of this move. So if the dollar does turn, I think gold pauses at the very least. If not, we see a pretty good pullback, not only in gold, but silver. And on the flip side, with the COT data, the gold and silver COT data is horrendous. But it's been very bad for quite a number of months. So the setup is there for, a dollar rebound and some weakness in the metals. And if we go to chart number 5, this is a chart of WTI, light crude. It's kind of the same thing as the dollar. Oversold, sentiment very poor, fell into an area, in the 60s to 70 area, very strong chart support, oversold, but again, we have the COT data turning bullish again, right where you would expect it. And, anecdotally, I've heard quite a number of comments about the energy stocks over the last day or two, business channels, and people kind of throwing in the towel on energy. So I would be looking for, a potential bottom. I'd be much more confident if we were able to just break back above the 72, 73 area. That would create a very nice false breakdown and retrace at least 38.2% of the decline since early July, late June. From April. So I'm looking for a nice reversal in a very unloved commodity.
Mark, anything else you'd like to add?
Yes, the other market that could be at an inflection point is TLT. I was looking for a correction in bonds right when the Fed cut rates. Prior to that, the 2-year, 5-year, 10-year prices, treasury prices, that has all ripped higher as usual in anticipation of a Fed rate cut. So it's kind of a, buy the rumor, sell the news here. That's exactly what has happened. TLT has come back from $101.5 down to, a recent 97 and a half. We have broken one trend line, couple shorter term moving averages. So I think this caught people off guard for some reason or another. We were overbought as well. But the longer term, the COT data for the 10s and 5s, I think for the 2s as well, is extremely bullish for bond prices. So once this pullback is over, I think the most logical spot, and of course that doesn't always work right, but there is a cluster of support. It's a prior breakout area, a 50% retracement, and that green trend line, rising trend line, comes in down in the 93.5, 94 area. So maybe we get an ABC, a three-wave decline back to there. And then I think we have another big run for TLT, which if we turn this into a 10-year chart, I think once we got below that 4% area, 380, there is not a whole lot, I've talked about this before, of what you would call support on the yield chart till you get way down to 325. So after this pullback, I think we'd see a nice move lower in yields, a nice move higher in prices and bonds.
Mark, thank you. Have a great weekend.
Thanks, Ike.